It is now my pleasure to turn the webcast over to Sheila Spangler, Vice President and Director for the Business Resource Center. Ms. Spangler, the floor is yours.
Thank you. Well, welcome to Expanding Your Business, What You Need to Know. A little bit about me before we get started. For over 25 years, I've worked with business owners in various capacities as a commercial lender, helping people borrow money to start or expand their business. I've done several SBA loans, which we're going to talk about today, so you get some exposure to that. Also, I've had my own business. I was a business broker, business intermediary. I helped people buy and sell and finance businesses. So I've seen it from that side of the table as well. In addition to that, I've also been involved in starting up and managing the Women's Business Center here in Idaho, and we trained over 500 people and provided one-on-one counseling, consulting services to over 300 people. So I'm excited to be here today to talk to you about what you need to know to expand your business and to answer some questions for you at the end of the presentation. So let's get started. You probably have heard the phrase, you've got to spend money to make money, right? It takes money to grow or start a business. But there's some questions you need to ask yourself. How much do you need? Where do you get it? And when do you get it? So we're going to work through that calculation today of how much do you need and some places where you could get it, and then talk briefly about when you should get it. You know, you've always heard that you should borrow money when you don't need it. Well, there is some truth to that, but you also need to be prepared so you know that when your business is having a challenge that you would sit down and talk about that with your lender or the people that are providing you money like an investor before it becomes a dire situation. Okay, so let's look at whether your company is positioned for growth. All right, cash flow and profit are not the same thing. We're going to talk about the differences between that here. I'm going to get all of these things up on the screen so we can see them. This is one of the things that, you know, I think have one of the biggest challenges that I've seen with business owners over the years, where they may have had plenty of cash flow that's coming into their business and they're able to pay their bills and stay afloat, but they don't earn a profit. You know, at the end of the year, there's no profit showing on their financial statements. And when they need to borrow money from a lender, they can't show that they have a profit. And lenders like to see profit because they believe that's what repays your loan. Okay, so is it possible, and I want you to think about this as we go through it, is it possible for a company to show zero profit but be able to pay all the vendors on time? As we've talked and you may have experienced, that's true. Why is that? Well, it may be that a company is in a high growth stage. So, you know, maybe they're paying all their bills and sales are growing rapidly, but they are, because of the expenses that they're incurring to grow, they're not able to retain a profit. So that could be a positive thing for your company, but you need to understand that before you sit down to actually borrow money or ask for investor capital. You need to be able to explain that and when you think your company is going to show a profit, or if you're just going to continue to grow for a period of time and need additional cash. And then also think about, is it possible to show a profit but have little or no cash in your checking account? Well, yes, it is. I've seen that situation in several circumstances. For example, let's say that you manufacture a product and you sell it to a big company who takes 60 days to pay you, but meanwhile you've got to pay your vendors in 30 days. So you might show profit on your P&L, your profit and loss statement, because it's tied up in your accounts receivable, but you don't have any cash in your checking account to pay vendors. So that could lead to a borrowing need. So these are some of the things that, as you're looking at your financial situation, to understand before you sit down with a lender or investor, to know exactly where you are in this curve. Okay, so where do we find capital? Well, there's several different sources, and as you may guess, you can certainly put your own money into it. That's called bootstrapping, or sometimes referred to as skin in the game. How much skin do you have in the game? You can get money from your family or friends. They can give it to you as a loan or a gift. There's also a quite popular way now through crowdfunding, which you may have heard of Kickstarter or Indiegogo, and there are several others. And this is the platform that people actually donate money to you to help you start or grow your business. And so I would suggest Googling that after you get off the seminar here today and learning about that. They each charge a fee, and you do have to be pretty good at marketing yourself on the campaign through social media and making a video and that kind of thing, because you need to build the excitement to get people to donate. There's also another platform for crowdsourcing, which involves accredited investors, but that's still got some regulatory hoops to jump through, so we're not going to talk about that today. This is simply a donation from someone. All they expect from you at the end is to provide them, some sample product or whatever it is that you've agreed to give them if they give you money. There's investors. There's angel investors. There's venture capitalists. There's, maybe Uncle Fred that wants to become an owner of your business and will give you some capital. So that's one way that you can get money into your business, but not every business is going to qualify for investor capital. We're going to talk about that a little bit later. Essentially, you need to have a scalable business model. We're going to talk about what that means. There are also microloans. These are generally small loans, less than $50,000, made by, they could be banks or they could be nonprofit organizations, typically made to individuals that have less than perfect credit. They have some challenges. So if you wanted to find out who some microlenders are, you could also type in microlender in Google, or you could go to Axion or Kiva. Those are two large organizations that make a lot of small loans that might work for your company. And then there's term loans. Banks, credit unions, and others make term loans, and those are generally for acquisitions of businesses or equipment. And then there is financing of lines of credit, factoring, leases, and that kind of thing. So each type of loan has its own purpose, and several or one may be the right one for you. All right, before we dive any further into talking about the numbers, I want to back up a little bit here. So if you're going to go to an investor or to a lender and ask for additional money, one of the things that is going to be asked of you is, where are you in your business model? Have you tested this expansion? If you're doing a startup, why is someone going to buy your product or service? What have you done to prove that? And one of the ways that's being taught around the country in several universities through their entrepreneurship programs is the Lean Business Model Canvas. And this was something that a gentleman named Eric Ries kind of coined the phrase, the lean startup. And then another individual who is a serial entrepreneur named Ash Maurya, and it's spelled Ash, A-S-H, and his last name is Maurya, M-A-U-R-Y-A. He wrote a book called Running Lean, and I highly recommend the book. If any of you would like to buy it and read it, it's not very long, and it's easy to read. You can get it on Amazon for about $20 new. But what this does is it basically explains to you how to test your model before you go out and spend a lot of money or incur a lot of debt. And what it will do also is focus you on 9 key areas of your business before you write your business plan. I know a lot of times when we mention the word business plan to people, their eyes glaze over and they get stomach cramps because it's a difficult thing to do. In a lot of cases, it looks like a term paper, but we're trying to make it a little bit easier for you, as well as using a model that helps you get to the point and understand whether this is going to work for your business or not. So once and we're going to briefly go through the model here in a minute, and then once you've done that, you're going to write your business plan and prepare your projections, along with a letter to the banker, which we're going to give you a sample and explain why. If you're requesting equity capital, you would prepare a slide deck, and there's a specific way to do that. We're not going to go into too much detail on that today, but we can certainly you can certainly send me questions on that later. And then you're going to pitch your request to the funding source, whether that is a lender or investor. So let's get started. Let's take a look at the Lean Business Model Canvas. So what I've done, and with permission of Ash Maurya in his book, he said anyone can take his Lean Business Model Canvas and improve on it. So I've taken it and I've added some questions to each of the 9 boxes here to help you as the business owner when you think about your business. And so I've called it the business viability model. So let's briefly go through this. We're not going to spend a lot of time on this today, but I want you to get the idea of it. And essentially, the thought is if you could make this big enough or put this up on a whiteboard, you would work through each of these 9 steps, and you can do it multiple times until you've honed it down to the process that's going to work for your business. You generally aren't going to be satisfied with the first time through. So, and it's called an iteration. Each time you go through it and think about it and change it, it's called an iteration, just so you know. So number 1, we're going to think about and define the problem that you're solving for your customers. Okay, so you would write 1 to 3 problems down here, or you'd put them on a sticky and stick them on the whiteboard in this section. Number 2, you're going to determine who is your target market. Who are you solving the problem for? What are their psychographics and demographics? How do you know that that is the person that you're solving the problem for? And number 3, what is your unique value proposition? And this is such a key thing, and a lot of times, even for businesses that have been in business a long time, have missed this particular point. And that is, what is it about your business that makes people want to do business with you? And how do you know? My question in this slide says, what is the single, clear, compelling message that states why your product or service is different and worth buying over all the other solutions, including doing nothing at all? All right, so this takes some work because you may not have thought about why people do business with you, but this is critical to understanding your positioning. Number 4, what's your solution? What's the features and benefits of your product or service? Okay? That's not to be confused with your unique value proposition. That's why they choose you. The solution is the feature and benefit of those things of your product. 5, how are you going to reach the target market? How are you, through paid and free channels? How are you going to reach them? 6, how are you going to make money? What's your revenue model? What does it cost to run your business? What's it going to take to break even? Your sales minus expenses comes to 0. What is that going to take, and how long is it going to take to get to break even? Or are you going to make money right off the bat, and how do you know? Number 7, what's the cost to start and expand your business? So these would be the places that you would identify those costs. And number 8, what are the things you're going to do over and over again, every day, every week, every month, to make sure that your business continues? What are you going to measure? Will you know that you're successful if you do certain things? What's going to tell you that? And then number 9, not every business has an unfair advantage. Typically, this is like an intellectual property, like a patent or a trademark or a copyright, something that no one else has, but it doesn't have to be. And so as you look at your business, if you really do have an unfair advantage, and this would be where you talk about it, but if you don't worry about it. Maybe you're just the first to market. Maybe you have the strength of location over a large geographic area. Whatever it is, you need to look at that for your business. So once you've done this, that's just a tool. You're going to write that down. You're going to put it in your business plan. You're going to have the narrative and the numbers, as we like to say, because that's something you can take to the lender or to an investor and say, here's why I need money, and here's how I know. Okay. So what goes into the plan or into your pitch when you're pitching to investors, if that is the case? And I like to quote Sergeant Joe Friday, it's just the facts, ma'am, right? I don't think that fancy charts or graphs is going to get you anything unless it tells a story that your audience needs to understand. Okay, I've seen a lot of times the software programs that produce business plans put out charts and graphs, and quite honestly, it's a waste of paper. So don't do it. We don't make the loan based on the weight of the business plan or the length of the business plan. It's on the meat of the business plan, or as the old commercial used to say, where's the beef? We want to know about your financials, how are you going to market your product or service, and what's your competitive advantage, and how do you know? How did you come up with your assumptions? How do you know you're going to sell 5 ice cream cones a day? What did you do to test that theory? and cite those sources. And it may be sources where you've gotten an industry report, and you can certainly use that to help build your case. We like to see that. And then who are your competitors? What are their strengths and weaknesses? And I know a lot of times people say, oh, I don't have any competitors. Well, yes, you do. In some form or another, you have a competitor, whether it's direct or indirect. So check out. They do some things well or they wouldn't be in business. What do they do well? What do they do poorly? Where do you fit? And how does your unique value proposition, work into that mix? And then why should they buy from you? Going back to that, what is your competitive advantage? And location and traffic count is not an advantage. I know a lot of times when commercial real estate brokers are trying to, get you to lease a certain property, they say, oh, there's 100,000 cars that pass here every day. Well, yeah, but how many stop? That's the question you need to be asking, is how many in my target market actually will stop here? So those are the things to think about that go into your business plan. All right, so we're going to give you some templates. There are several out there, but these are three that we like. Obviously, we have some resources for you on our website. SCORE, which is another service that is an SBA resource partner, has some great templates, as well as the SBA itself. So you will have access to this webinar after the presentation is over, so you can get these links. All right, well, let's talk about how much money do you need to expand. And this could apply whether it's a startup business as well. So there's a difference between one-time upfront costs and ongoing monthly costs. So if you're going to expand your business into a new market area, there might be some things that you need to do. And I've just listed some samples here. This is just, my made-up business. So in this case, I need to improve my website. I need to set up an LLC. I need to buy some equipment, some inventory. I need to have a grand opening. So my total here is $50,000. Okay, so I know that I need at least $50,000 to expand my business. And I would encourage you to put this information into your business plan or your pitch so the person that you're pitching to knows exactly what it is that you're asking for and what it's going to be used for. That's very important. And then as a lender or investor, I am going to need to know what expenses are you going to have every month that you're going to be running your business, because you might need some working capital to cover those expenses until your revenues get to a certain point to cover them. So in this case, I just listed some typical monthly expenses, and this is like a home budget, right? You sit down and and all of you do a home budget. I'm sure you do. You sit down and you say, how much do I pay for rent? What do I pay for the phone? How much do I pay for postage, insurance? All of those things that you're going to pay on an ongoing basis every month to run your business. And then in this case, I added in a loan payment. So that might be debt payments that you already have, or it might be debt payments for the new debt that you think that you're going to need. And so sometimes you have to back into this number and make an estimate to come up with a monthly total, but you get the idea. So in this case, it's going to be about $11,700 every month to run my business, in addition to the $50,000 I need up front to start or expand this new division that I'm going to do in my made-up business. Okay, so now that I know that, so the expansion costs are $50,000 that we determined, and we just saw that our monthly ongoing cost is $11,700. So how did I get the $70,200 here? Well, that's about 6 months worth of the monthly ongoing costs, because I know in my business here that it's going to take me a while to ramp up my sales to cover my overhead. So I need to ask, in this case, the bank for money so I can put it in my checking account to cover those costs until my sales are going to cover the expenses. And then in this case, I'm going to have some closing costs. So my total that I need to do my expansion is $125,000. Well, where am I going to get that? Well, I'm going to put my own money in, about $15,000. I'm also going to get Uncle Fred. He's going to put in another $10,000, and then I'm going to come to Zions Bank and borrow $100,000. This is in my pitch. So the 15 and the 10, $25,000 is about 20% of the total, 20% of the 125,000. And that's typically what lenders look at to see how much skin you have in the game in order for them to consider making you a loan. So they know you have something personally at risk. So, and this little chart, I would highly recommend that you put in your business plan or in your pitch. That way it makes it clear. How much do you need, how much you're asking for, and where are you going to get it? You've thought this process through. So now let's talk briefly about, should it be equity or debt? Well, not every company is going to qualify for investor capital. One of the key criteria for investors, angel investors or venture capitalists is your business scalable? And what that means is it something that can go, nationwide, worldwide? Is it a product that millions of people want to buy, and is it going to be continued for a long time, right? They also look at the secret sauce, and this is, do you have a patent or other unique positioning? Do you have a copyright? Are you like Coca-Cola that has a secret recipe that no one can see, and that makes their product unique? So these are the things they look at. And they also want you to have an exit strategy. In other words, when you make the pitch to get the money, they're going to ask you, who would buy you? And when would they buy you? And why? And so the reason that investors put money in you into your business is they want to get 10 times their investment back in 3 to 5 years. That's the liquidity event. And you have to be willing to accept that risk. You're not going to run this business for 20 years. You're in and out. So if that's the kind of business you have, then that might be a good idea to position yourself to pitch to an equity investor. If you're not that kind of business, if you, let's say, and I refer to it as a Main Street business, when you drive down the Main Street of your town and you look around, the kind of businesses you see there are typically businesses that generally qualify for debt financing. You don't give up ownership through investor capital, and if you do, it might be to friends or family. And typically the cost for getting debt is a lot cheaper than equity because you're not giving away control. So that's kind of the difference there in how to decide whether to go for equity or debt. Financing. Let's talk about how we use it. Well, as we've mentioned, you can fund your startup costs or expansion costs, working capital costs. You can buy a business. You can buy fixed assets like commercial real estate, equipment, vehicles. And you can also manage the gaps in your cash flow. And what is that? So I grew up on a farm, and so my dad every spring would get a line of credit to fund his operation. In other words, he had to plant the crops and till the crops and, fertilize the crops, but he wasn't going to get paid until the fall when all of the crops were harvested and he sold it to the buyers. And so he had a seasonality of revenues. And so in other words, he needed a line of credit to fund his business, and then in the fall, the line would get paid down, and what was left over was the profit. So there are many businesses like that besides farming where the cash flow may fluctuate during certain periods of time. Or if you have a business where you are generating accounts receivable, let's say you manufacture a product, a bicycle. It takes you, 30 days to manufacture a bicycle. You sell it to Bob's Bicycle, and he takes 60 days to pay you. Well, meanwhile, you have to pay for all your materials in 30 days. So you have a gap of 30 days. 60 minus 30 is a 30-day financing gap. How do you pay for that? You might use a line of credit, and banks and others can provide those kinds of financing tools for you. So how do we make a loan? How do bankers decide what they're going to do in making you a loan? I want to spend some time talking about that. Well, first we look at the purpose, as we've discussed. What's the purpose of the loan with the type of loan? So in other words, if you need a line of credit because you have accounts receivable and you're not going to get paid for 60 days, but you need to pay your vendors in 30, that would be a line of credit type of purpose because it's for working capital. It's flowing through your business. But if you're going to buy a building, then that would be a term loan because that's an asset that's going to stay around. You're going to own it for 20 years. It's going to be depreciated over time, and so you need to pay for it over time. Also, there are some financing vehicles for exporting, and we have some great people in our international banking department that can help you with that if you are exporting a product to your overseas customers. And then we also look at what's the loan repayment source. So, for example, like the line of credit situation, the repayment source is the collection of the accounts receivable. But on the commercial real estate loan, you're paying back that loan with your profit, the profit you generate in your company. All right. Some of you may have heard that lenders use the 5 C's of credit to make a loan decision. And that is true, but a lot of times people don't know exactly what those 5 C's are. So I'm going to share those with you. So now you can tell all your friends at the next party you go to, I know what the 5 C's of credit are. So the first one, and this is when I learned to be a commercial lender, I was taught that out of the 5 C's, character is the most important. Because if you don't have the right character, none of the rest of the C's make sense. But this is where commercial lending becomes kind of an art form, right? Yes, we look at your credit report because that indicates how you've paid your bills in the past, how you've repaid your other creditors. That's part of the character. But we also look at how you've run your business and managed your vendor relationships and that kind of thing. The second C is capacity. We look at your financial statements and your projections. How are you going to pay us back? How do we know that you've been able to do this kind of thing in the past if you're looking at expanding? Or how do we know if you are a startup that you might generate positive cash flow going forward? This is where the business plan and explaining how you know things about what you're going to do or sell comes into play. Capital. We look at how much of your own money have you put into the business. That's skin in the game. How much are you putting at risk? Collateral. Collateral is, for example, if you're going to buy a building for your business, the building and the real estate would be the collateral for the loan. Or if you're going to buy a piece of equipment, the bank takes a lien on that equipment to secure the loan. It doesn't replace the other 3 C's, as you can see here. It is an additional C. And finally, the last C is the condition. What's going on in the economy that may affect your industry or just in general? So the lender that you are applying for a loan with has to look at that and say, I'm concerned about this particular industry because, and this is where your business plan and your research comes into play to help the lender get comfortable with whatever challenges there might be in the conditions. So it's kind of like, it's a recipe. We look at all of these things and we make a decision based on this information. Okay, so how do I choose a lender? When I had my own business, I was a business broker, business intermediary, and I would guide people through the buy and sell process. And I would also take them and introduce them to lenders so they could make the pitch to get the loan to buy the business. And I would encourage them, and I still encourage people today, is to interview your lender. Ask the lender that you meet with, have they ever made this kind of loan? How many have they made? What kind of loans does your bank like to make? And then again, do your homework and find out what's the financial strength and experience of that lender. So these are things you need to know because not all lenders are the same. You need to find out, are they an SBA preferred lender? If you're going for a startup or an expansion loan, a lot of times the Small Business Administration loan guarantee is used. And so you want to make sure that you're dealing with someone that knows how to do that. And this was one of the things I would tell my clients when I had my business brokerage is that while every lender may be able to make an SBA loan, not all of them can do it easily. And so there's a status called SBA Preferred. And what this means is that the Small Business Administration has given designated authority to the bank to make the loan decisions on their behalf. So it saves time and effort. Now, it does, I'm sure you've heard oh, SBA loans take forever and there's a lot of paperwork involved. Yes, there is paperwork involved, but the other option is not getting the loan at all. But when you're dealing with someone that knows how to do it, it's going to eliminate a lot of time. And if you provide all of the information that is requested up front, and which that's one of the things that we do here is show you what you need to provide so you can get through the process quicker, so you can move on and expand your business. And Zions has been the #1 lender for over 12 years here in Idaho and 20 years here in Utah as an SBA preferred lender. Okay, so what is the SBA? I've talked about it. You've heard about it. You may or may not know what it means. The SBA is a government agency, the Small Business Administration, and it offers financial programs to help small businesses, not just loan guarantees. They have a lot of other programs, so if you're interested in finding out what they do, for the sake of time, I won't go into those others today, but you can go to SBA.gov and check them out. Excuse me, I'm a little hoarse here. We're going to talk about how the SBA loan programs work. Well, the SBA does not make direct loans to businesses. Only banks do that, and then they apply to get the SBA guarantee, as we discussed. A lot of times you can think about it like if you've ever gotten a mortgage loan on your home through the Veterans Administration or the FHA program, it's a loan guarantee. It guarantees the lender in case you default on the loan and the lender has managed the loan correctly, they can apply to be reimbursed for part of the loss. Now, we don't like to see that happen. Obviously, we don't want to make a loan to have a loss. But what the SBA loan program does is encourage lenders to take risks and to make loans that they may not have been able to do otherwise. So that's why the SBA is a very strong partner in helping businesses and banks make loans and get that out into the economy so we can grow and have new businesses and new opportunities. And those loans are made based on SBA guidelines through the lender's approval process. So there's two types of SBA loans, the 7A program and the 504. The 7A program, you can do just about anything. You can buy a business, you can start a business, you can buy fixed assets, including real estate. You can fund the improvements in a piece of leased property. Let's say you're going to start a retail store and you need to, do some build out. You can fund that. You can also get the working capital that we talked about for your operating costs until your revenues are such that they can start paying the loan back. That's what the 7A does. Now, the 504 is only for fixed assets. In other words, it's generally for existing businesses that want to buy a building or a piece of large equipment and to fund that over a 20-year period, generally at a pretty good low interest rate. So if I'm not going to go into the details of each of the programs because you can go to SBA.gov and get a lot of information, or you can send me a question and I'll answer those at the end. All right, so let's talk about, now that you kind of know a little bit about your business, you've gone through your lean canvas, you've tested your theory, you've outlined your costs and expenses. Now you're ready to sit down and write a letter to the banker, all right? And in this letter, you're going to list the strengths of your loan and also the weaknesses and what you're going to do about them. And a lot of times people say, well, why would I want to tell the banker what I think the problems are in my business? Well, I can tell you what, the banker is going to figure that out as soon as they read all of your financials and your business plan anyway. So it looks better for you to identify those things and say, yes, I know this is the weakness and here's what I'm going to do to fix it. Because what that will do for you is make the banker sit back and take notice and say, wow, this person really understands their business and they're probably someone I want to do business with, because I can trust them. Remember, it goes back to the character. It goes back to the I know who you are kind of thing. You're going to list 5 reasons why your business will succeed based on your analysis, and then you're going to ask them for their time and pitch that to them along with delivering your loan package. So what goes into the loan package? Well, that's the financial application that the lender gives you, as well as all your financial statements and your tax returns and whatever is on the list that they're going to give you. I won't go through that now, but we can certainly provide you a list if you want to send an email later or a question at the end of the presentation. So this banker letter template is something that I've used to do when I had my own business, and now I provide it to our clients here in the Business Resource Center. I encourage them to really think about the things they put in the letter, because this is going to assist the commercial lender in making your loan. And I don't think you can read this here on the screen, but when it's posted, obviously, you'll be able to read it a little bit easier. Or again, for any of you that want to provide your email address, I will send you the Word document so you can use this. But what it does is you have to know your business before you can write the letter. And I don't know, a lot of times people didn't realize that when you go to the bank, they don't just take your financials and your tax returns and kind of look through it and say yes or no. They actually have to do an analysis of that. There's someone in the bank that looks at all the numbers, does financial calculations, actually has to do a write-up and basically take your financials and write a story about your business and say, here's why we should do this deal. Here are the strengths and weaknesses of the deal. And if you help them out by doing that, then you're going to build a stronger relationship and hopefully, get what you want. And obviously what you're doing is helping the lender see that you are a savvy business owner. Okay, so now you have your package and you have your letter written. Now it's time to contact the lender. Well, as in any kind of situation where you are, presenting yourself, whether it's to get a job or meet your children's teacher, you want to look your best. So dress professionally, dress appropriately for your business, and bring copies of your completed loan package, which means all your financials, all your tax returns, everything that was on the list that the lender provided you. And here's one thing that may sound a little different. I'm going to tell you not to, or tell you that you should ask the lender not to pull your credit report until they tell you that there's a strong probability that they like your deal. And here's why. Every time a lender pulls your credit report, it shows up, and it also, reduces your score a little bit. What you should do is pull your own credit report before you go to the lender, and if there are any negatives on there, write a letter and explain why this negative occurred and what you did to fix it, because that shows that you're of good character and you're trying to do what's right and explain things. But if you bring that in with your package and sit down with the lender and say, here's what happened, when the market crashed in 2008, I was late on several bills, but here's what I did to fix it. I brought everything current, but it is going to show a late payment. Write the letter, be honest, sign it, and explain it. Now, I'm not saying that the lender in every case will be able to approve your loan, but what it will do is build that trust, and they're going to do everything they can to help you, because the person you meet with is your advocate. So you want to give them all of the tools they need to go advocate for you for the person that is going to make that credit decision, because you'll not be able to pitch to the person who is making your final credit decision, but you're going to pitch to the person that's going to be your advocate. So hopefully that makes sense. All right, so let's say the lender has some questions for you, or that something was missing in the package. Be sure to get right back to them, because in many cases they are not going to be able to submit your package until they have absolutely everything they need. And here's the other thing we talked about timing of SBA loans or any kind of loans take so long to get. Well, a lot of times the reason for that is the lender didn't get everything they needed to go into the package. So they're waiting for you to provide it to them, where you think you're waiting for them to give you an answer, but they can't give you an answer because they don't have what they need. So make sure that you understand that you get everything you need and have them give you a list. And always tell the truth and ask for a timeline. And then follow up. Now, when I had my own business brokerage business, I know a lot of times the buyers of the businesses that I was selling said, well, let's take it out and show this proposal to 10 banks because I don't want to wait around. Well, you can do that, but what it does is the banks are going to find out about it because some of them are going to pull credit, and then, whether you ask them to or not. And then the person you're trying to build a relationship with says, well, gosh, you're not being honest with me, and so I may not be able to help you. So we want to give one bank a shot, and then if they say no, and you find other reasons why, and you don't want to, mitigate those reasons, you go to the next bank. So try not to share it with different banks at the same time if you can. And then these are just some tips that some things I've heard over the years, from people that wanted to borrow money. As you've learned today, you're going to know how much you need to borrow. You don't go to the lender and ask, how much can I get? Because that tells the lender you haven't done your homework. And why would I lend to somebody that doesn't know their own business? And don't put undue pressure on the lender. I have to close by the end of next week. Now, there are times when perhaps there's a deadline that you have to meet, but that's why you develop a relationship with your banker. And so if those things come up, they understand your situation and will do everything they can to help you. But if you have never met this person before and you think coming in and putting high pressure on them is going to help you get the loan faster, it won't. Also, remember how there are different kinds of loans for different kinds of situations. And so asking for a credit line to buy equipment is probably not a good idea because equipment is going to last 5 to 10 years, so you would need a term loan for that. A credit line, remember, is to fund financing gaps, short-term needs. And then finally, don't say, I will not personally guarantee this loan, because in most cases, you will have to guarantee, especially if you want an SBA loan. It's just the way it is. The lender wants to know that you have, again, skin in the game, not only your capital, but you're willing to back it up. Because, quite honestly, the lender is putting in more funding, when they fund the loan than you have. If you're putting in 20% of the project amount, they're putting in 80%. So, that's just something that happens, and there's not likely a way around that. In my banking career, I think I only was able to do one deal where I didn't have a personal guarantee, but that was extenuating circumstances there. So anyway, well, what happens if your loan is turned down? Let's say that you've done everything right. You've put your package together, everything is there, your credit report is explained or it's perfect, but you still get turned down. Well, find out from the lender why, because they have to have a reason, maybe at least one reason, sometimes 2 or 3, but ask them for the why and make sure you understand it. And then find out if there's a way to mitigate those reasons, because sometimes there is. For example, I've seen it where people want to start up a business and they don't have some exact experience for a particular industry, but the lender might come back and say, gosh, if you had a co-signer or another guarantor to help back up this deal that has experience in this area, I would do it. I mean, there's sometimes that you can find ways to get around the decline, so be sure to talk to the lender about that. Now, in other cases, it may mean that the bank has simply reached its maximum limit on a particular kind of loan in a certain industry. I remember there was a time, and it may still have occurred, but lenders had made a lot of loans to different hotel companies. And so the bank the bank I worked for at the time determined that they weren't comfortable making any more loans to hotels simply because in their portfolio they had enough capacity in there. And so when a lender has to look at the mix of the portfolio and manage that, and it's really important, especially on the commercial real estate side. And so just because one bank turned you down and said it's because we can't make these kind of loans right now, it doesn't mean your loan is not a good one. You just might have to try another lender. So that's why it's good to ask these questions. All right, so let's say you're approved. Great. Well, now make sure your lender has everything they need to close the loan. And then please read the loan documents. I know a lot of times people just want to sign and get the money, but make sure you understand what's in there before you sign it. And then go to work. Put the money to work in your business and stay in touch with your lender. And if you ever have issues in your business, be sure to talk to the lender about them, because a lot of times they can help you through the process and make sure that your cash flow is smoothed out, and they're going to stay in touch with you also to probably get some financial statements to know how you're doing. So now what do you do? Well, your next steps, should you choose to take them, if you want to start or expand your business, you can make an appointment with a Business Resource Center representative. And so we have a Business Resource Center in Boise and in Salt Lake, and we're here to help you. We can review your business plan, or if you don't have one, we can help you craft one. We can also work with you on developing your projections that you need for the plan. We can refer you to the right lender for your needs, not only just with Zions Bank, but if it doesn't work for Zions Bank, we know lots of other folks that can help you with things. If you don't have a plan, as I mentioned, we can sit down and customize the help for you to get what you need. We also offer other in-person training classes that could help you as you're progressing through your business ownership. And so with that, that's all I have for today. And there's a picture of our locations for the Zions Bank Business Resource Center. So
if you would like to ask a question over the phone line at this time, please press star 1 on your telephone keypad. Again, that is star 1 on your telephone keypad to ask a question over the phone line. Please hold as we pull for questions.
And there's no questions at this time.
Okay, well, thank you for your attention today, and I hope it was valuable. And again, if anyone is interested in getting any of the handouts, you can provide your email before we close out here. And if not, you can find it on the Zions Bank blog in a couple of days. So thank you very much.
Thank you again for joining us today. We hope you found this webcast presentation informative. An archive of this presentation will be available 72 hours after this broadcast. This concludes our webcast. You may now disconnect. Have a great day.